Good morning, everyone, and welcome to another episode of the Crypto Hour. First of all, a little bit of housekeeping. Excuse me. Okay, I'm going to be away for the next 2 weeks on holiday. So there won't be a Crypto Hour for next week or the week after. So the next time will be at the end of September. So today we'll try to look at something that you can be a little bit meaty for the next couple of weeks. So at least you got something to think about, and we'll see in roughly a month's time, 3 weeks time, what has actually happened. If any of the things I'm saying are actually happening in the real world. So let's start, as usual, very quickly from the economic calendar. So not too much going on. Where are we? What day is it today? 6th of September. So say not too much went on this week in terms of announcements. Just a rate announcement from Canada. Again, another 0.25% drop in interest rates. And the big one is today with the non-farm employment change, which again can move the markets quite dramatically. So this is what can push. I mean, the Fed pretty much announced that they're going to be like an interest rate cut, but the numbers that are going to be announced today are what can affect the size of that cut. So at the moment, everybody expects a 0.25% cut in September. But if we have very bad numbers today, then we could have, a little bit more, like 0.5% being announced rather than just a 0.25%. So in the next couple of weeks, what do we have? Okay, next week we got inflation figures, CPI for the US on Wednesday, CPI and PPI, interest rate announcement for the euro on Thursday. And nothing else much. And the week after is the one. So before we come back, again we're going to have the big one, which is the interest rate announcement for US dollar on Wednesday, the 18th of September. The pound the day after, and the yen on the Friday. So this is going to be the week with the biggest uncertainty. 3 big announcements, one after the other. But again, pay attention to what goes on today, because big adjustments may happen in price, especially if the number of the non-farm payrolls here, which is expected to come in at about 164,000, so higher than it was last month. If it's considerably different from expectation, then prices are going to move quite a lot. And especially the dollar has been pushed down of late. A strong number higher than 164 could push the dollar back up. A lower number can push the dollar down. So very quickly, those of you that listen to economic news, CNBC and Bloomberg and so on, might have heard a lot of time talks about the economic cycle. So we kind of mid-cycle, late cycle, early cycle. What does that mean? Obviously economic cycle, things go up. But at the beginning, what we call of an economic cycle, things are going strongly. Everybody's looking on the up because the economy is doing really well, etc., etc. Then there's a plateau that's reached, and then there's like a late cycle when things start declining, and things are not looking as rosy. So where are we today? Are we early? Are we in the middle? Are we late? So it's not just a matter of opinion, but we can have a look at data to see what stage we're at of the cycle. This is what I prefer doing rather than saying I believe this or I believe that, which it's just a matter of opinion. So we'll go down and have a look at a few bits of data. Where are we? Sorry. Okay. So these are the 5 indicators that we'll be looking at, which are representative of the economic cycle in the US. This is the National Bureau of Economic Research, which has a real growth gauge, which is an average of 7 indicators that we're going to look at in a moment. And it's the one that's used, to decide when the economy is in a recession or not. Then we'll have a look at retail sales in real terms once stripping inflation, and that shows the shows the health of the U.S. consumer market. Then the job market in U.S. cyclical industries. So industries that vary their recruitment a lot depending on how well the economy is doing. Then the yield curve, which we talked about in the past, extensively, and see how many months of yield curve inversions have we experienced. So this is the yield curve, I remind you, is the yield on the 2-year notes against the yield on the 10-year notes in the US. So generally speaking, the longer term duration, will offer a higher interest, because obviously you park your money for a longer term, so you ask for more reward. But lately we have been, the curve has been inversed for quite a while, so that the short-term yields have been higher than the long-term yields. And then the last one is the debt service ratio. So how much of a consumer's money and company's money is being used to pay for to service debt. And so obviously the higher the number is, and the less money there is to spend on other things, on discretionary spending. Okay, so let's have a look at each one of these one by one. So this is the the growth of the NBER. It's the National Bureau for Economic Research, and these are the actual indicators that they look at. So all of these, I'm not going to name them all, but you can read if you like. And when you see these numbers here, the number highlighted in yellow is the actual number which is compared to the 20-year average. And that number will vary roughly between 1 and 5, with 5 being kind of like indicating strong growth, and 1 indicating or early. Let's say 5 would be kind of like a very early cycle, and 1 indicating poor growth, and that we are kind of late in the cycle. Okay, this one in kind of the growth at the moment is quite low, just hovering just about a 1%, just above. You can see the 1% mark, and the value is about 1.2%. The next one is retail sales. And the other thing that's worth considering is that how do we are in percentile, so whether we are now compared to the average. And this is in terms of growth, we are on around the 26th percentile, so quite low so if you think about 50% of being the middle, 26th percentile, so means that we are quite low on average, on long-term averages. Retail sales, again, this might indicate the health of the US consumer sector, which has been, I can say, in the past as high at 7% and above. At the moment, again, it's below 2%, and also in terms of percentile, we're down to the 25th percentile. So again, not strong growth from the consumer sector. And again, the value indicator is 1.6, again quite far away from the 5 that we would expect, or closer, the higher values, 3 and above, that would be indicative of an early cycle and strong growth. Here we got the non-farm payroll.
So how do we compare against for stuff?
Sorry, Kim, I just muted you. I didn't know if you wanted to talk or if you were just talking in the background. I just if you want to say something.
I was just wondering, these are in November. We'll be able to look at this compared to some of this stuff now to see if it's in a different place, because this is almost, we're like 10 months down the road. Just a question, that's all.
Yeah, but this is kind of the numbers that don't, they don't get published. They don't get published, every month. So this is a lot of these are research that comes like 6 months afterwards. So this is why we're looking at this data, but it doesn't, we're looking at kind of like long-term trends of where we are. So, don't worry about the, what you see right here, but it's we're looking at where we are in the cycle, what position we are in the cycle. They're not necessarily important to look at the latest possible number, possible month. We need to see how all of them are combining and the latest data that's available for all of these indicators. Okay. After this one, again, we're looking at the private sector debt service ratio, which is, in a way, this is the one out of these indicators that we're looking at, these, to see where we are in the cycle, is probably the more positive one, in the sense that we're still around the 59th percentile, which means that although there's been like a strong hiking of interest rates, trying to stop basically US consumers for spending a lot of cash, okay, and this has taken a long time to filter through to the real economy. Okay, so even now we are at long-term averages, just about what is normal for the US consumer in terms of how much money is spent on paying for the mortgage, for the debts, for the loans, etc. But although we can see the increase from 2022 till now, so we're going back to around long-term averages level, but it hasn't really started to bite very strongly yet. So as you can see here, kind of like in terms of, and you can see this then in the stock market. Why has the stock market has a very good performance pretty much since 2011 until now, is because the amount of money available in the pockets of consumers was historically very high. And even after 2020, although we had a pandemic, can you see that the people had more money? So the lower this value is, it means the more money people have to spend, because they're spending less for their loans. So it means that the rest of what is out of, this is like, imagine 13, you deduct that from 100, that's what's left to be spent on other things. Okay, so at the moment, if the value up here was 87, now it's 80, 85, 84, and it's still a kind of like historically a very high level of available disposable income. Now, the last one that we're looking at is the yield curve. And so you can see in the past, when the yield curve has gone negative, it's not so much the fact that we are negative that is the problem in the recession, but it's as we leave and the curve starts steepening again, this is what generally is followed by a recession. And we'll have a look in a second as well. In terms of employment, we have now, in July, we've triggered what is called the SAMS rule, which is when the unemployment grows more than 0.5% above the long-term, falls more than 0.5% above the long-term low. And that generally is followed by a recession too. So there are quite a few things that are pointing towards a recession and towards being late in the cycle. Now, if you put all these things into a calculation, we can show you how we can calculate things. So these are the 5 things that we're looking at, and these are the different values. So there's the median value here in the middle, which is like the long-term average, and then we have the extremes, like the 10th percentile and the 90th percentile. Okay, and this is where the values are today. Okay, so you can see that retail sales, we are below the kind of half of what the median value is, so it's kind of like very weak. The growth as well, again, it's half what the long-term value, again, very weak. The employment figures, half. So can you see how these things are not, this is enough made up figures, but it's you can see they're pretty much like half of the long-term averages, all of them. And the yield curve is something that's never happened before so far. Kind of like we had 28 months where the curve was either negative or flatter than 25 basis points. And in terms of what we are talking about, they said the percentile of the debt service ratio, which stands at 59%, and you can see now is starting to climb above the median value. So this is why, although the effect has been very slow, it is now just about starting to bite. So we've gone from levels that were historically very, 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 very low, so below even the 10th percentile. So we were in, after 2020, we were at 13% values. And now we actually are climbing towards the higher part of the past when things are really starting to be difficult. We are, here we are getting close to spending basically 1/5 of every dollar that we have available in paying for our debts, which obviously restrains how much we can spend in other things. So in terms of scores, we can see that the between 1 and 5, with 1 being the worst possible value and 5 being the best possible value, the aggregate value, the average is 2, which indicates we are late in the cycle. Okay, so this is what happens when we are late in the cycle, and then we go into a period where, if you can imagine the line going up and then down and then up again. So we are approaching the lower part of the cycle, which means that whether there is a recession or not, remains to be seen. That's a monetary phenomenon, but there will definitely be a bottoming out and a slowing down. As we can see, all the indicators are pointing in that direction. So, and this is why sometimes we look at, different things, like we look at where are we in terms of different indicators. Okay, so for example, we look at the S&P 500. Let me just do this. Can you see? I know it's quite faint, but you should be able to see. So the S&P 500, so this is the price earning ratio. You can see that historically, we are now into this like light pink band. What has happened in the past? So this goes back to 1875. Okay, so every time that we've been in this kind of a ratio range, okay, so there have been cases where we actually moved into the red. Okay, these are more recent cases, but you can see in the past, every time we have been in this range, is being followed by a decline period of decline and going back into this kind of like yellow, very wide band. So I'm not saying this will not tell you exactly when things are going to happen, and potentially there can still be a period of upside, especially following the cut in interest rates. But in terms of turning around, we can see what happened in the past, and this is like excesses that may last for a little while, but are followed by a sharp decline. So this is where you want to be careful, and you want to consider different elements of your investment portfolio. By the way, this is a really good website that you can where you can see a lot of these charts. Okay, so we got many different indicators. You can see it, things in gold, like stocks against the gold, etc., etc. Okay, so it's really interesting to look at long-term trends, okay, and especially to tell you, where we are in the cycle. Now, for example, it's this one chart I wanted to show you for let me see, for how did I get that? Let me see if I can find it. Okay, I'll show you when I can find. I think I might have already snapshotted it. Let me see. Okay, this is an interesting chart. I'll tell you, probably I don't want you to just restrain and look at exactly what it is. Okay, but just look at the long. So this is very long time. So it goes down to 1860, and what it shows you is how expensive the average home is in if you were to buy in gold. So just imagine, when do you think it was the best time to to have a house as an investment? And where are the drivers that that get us to to move from what is may be considered to be cheap to what is considered to be expensive? So if you see this period here is the period following the war. Obviously, a lot of the housing stock was damaged, and again, the economy started picking up. So, buying a house became considerably more expensive over time, and especially when you consider that in this chart the dollar doesn't really come into it. Okay, so it doesn't really matter how much you paid in dollar terms. This is priced in gold. So what's the other thing that chart like this can indicate? Well, it can indicate very clearly when things are cheap or when things are expensive. But we can see that in general terms, it's now cheaper in terms of gold to buy a house today than it was in 150 years ago. That means that there have been more houses that have been built than gold has been got out of the ground in that time. And the other thing that it can show you is that when things are overpriced, like up here, for example, so this was in the why do you think we had a peak here? What happened at this time? Can we see this is roughly just after 1970? Anybody have any clue what happened around that time?
Has that got to do with the oil prices?
No.
Gold.
It's gold. It's gold. So it's when the dollar. Oh, what happened there? When the dollar decoupled from gold. Okay. So basically, the gold that was supposed to support the value of the dollar could not be exchanged at a fixed rate if you went to a bank. Before that date, you could go to any bank and exchange your notes for a fixed quantity of gold. After 1970, it became just floating. And so in obviously, then what happened is that money started being printed and gold was not accumulated as a reserve for the money. So the real value of money became less. And so as from 1970 to 1975, so we've gone from you basically you could buy the same house with 80% less gold in 5 years. So would that been a good investment? Buying a house in 1970, would it have been a good investment or not? Not really. Okay, so and then we had this the low that was reached in 1980, and then we had a kind of like a long period of again prices becoming progressively higher until we had the dot-com boom, and then what happened here in this case? We had the big financial crisis, okay, 2008. So when is really the best time in history that to be invested in property? It was right here. In 1980 or 2011, obviously more recent history, more interesting for all of us. So if you bought a house at 2011, when everybody was suffering because of the financial crisis, you would have done pretty well. and not obviously as much as from 1980 to 2000, but you would have gained about 30 to 40% in terms of real value. Yeah. Okay, so in terms of gold, buying a house for gold in 2011, and it would have been a good investment. Okay, in sense of
Looking at the charts,
sorry.
Looking at the charts, it actually doesn't seem such a bad time to buy it now compared to the wartime years when it was actually higher.
Well, yeah, I'll say historically now we are pretty much close to long-term averages. So we can see this at the value of between 300 and 200. So these are the levels that we had in before the First World War. Okay, so this is how much you would have paid to buy a house here in the last century. So what I'm saying is that it doesn't matter what the monetary value is of your assets, but in terms of long-term value, when you think about it, if you want to pass something on, like you want to help your children to buy a house, for example, what is the best thing? Is it best to actually give them something that can allow them, to buy a house at the right time, or just give them the asset itself? Obviously, if you were a peer, imagine, and you wanted to give your children something of value, it would have been a lot better to give them gold than give them a property. And apart from the fact that, obviously gold, and I'm not really saying this to encourage anybody, but it's a gold that can be also shielded from curious eyes, let's put it that way. So can you see there are times now where things are overpriced, and times where things are kind of fair value, or things are underpriced. Okay, so we have two cases here in the 1980 and 2011 where things have been underpriced, and also we can see right here at the end, 2020 is when we had a big drop in property prices. Now we're not that far from that low, so we still only about 15-20% higher than the low that we reached in 2020. So is this, what would you say, is this a kind of like a, historically speaking, would this be a good time? I'm not saying that we reached the low or anything, but would this be a good time to buy some property, or a bad time?
Good time.
Good time. Exactly, because we stripped out any inflation, obviously. And the other thing to consider is that if we're going towards a recession, people get worried, people get scared. Obviously, people might lose their job and realize some of the assets that they have. So it's normal for some of the assets that are priced in dollars to reduce in value, because there is less demand. Okay, and this is why sometimes precious metals like gold or silver or platinum can be interesting as a way of surfing the economic cycle, because they can give us, especially in moments of turbulence, that could be during a recession, or it could be during a war, for example, can give us some certainty, because there isn't any easy way of increasing the supply of precious metals, and this is why they've been used for thousands of years as a form of money, where there is a very easy way to increase the amount of cash in circulation. So in a time when money is becoming in a way, so people are less prone to spend money because they're worried about the future. You know, the idea of having something that keeps its value over, you know, in turbulent time is attractive, and this is why we're seeing gold prices also going up. So I wanted to finish this to show you because they, you know, we've been going into some turbulent times with crypto as well. And one thing you can do, I don't know if you knew that, for those of you that use TradingView, one of the things that you can do, so this is the price of Bitcoin, and again, as you can see, we're quite depressed at the moment. We're still within this range between 50 and 75. But, you know, over the past couple of weeks as well, price has pushed down towards the lower part of this zone. Okay, but if you can see, when did this price stop before? Okay, and is there any reason why it stopped at just around 50,000 and not somewhere else, not at 52, not at 45, not at 46 or something? And if we look at the price of Bitcoin in gold terms, you know, we get our answer a little bit. We can see there's a very strong level of demand that goes between 21 and 19 ounce of gold per Bitcoin. And even, you know, this is the place exactly where it stopped at about 21 ounces of gold per Bitcoin, where it was a strong push up. And again, this has got nothing to do with the dollar. This is the price of Bitcoin in gold. So, and this is the chart. Okay, we can see. So where are we now? We are now at 22 ounces. So where were we in the past? What did we reach? So we are beyond the high of prices. Although the 2018 bull cycle was very, very, very violent. So it went, as you can see, from 2 to 16 ounces of gold per Bitcoin. Okay, we are at a level now which passed the previous bull cycle, the top of the bull cycle in 2017, and was reached in January 2021. So in real terms, we are back at the levels that we had at the beginning, I would say halfway through the bull cycle that started in, you know, in around December, January of 2020, and January 2021. And we revisited those levels. So we revisited exactly those levels last year in November, you know, 2022, January 2023, before having another really real push higher. You see, in gold terms, Bitcoin hasn't established a new top yet. So even this is in dollar terms is a new all-time high. In gold terms, it hasn't yet. It's still, the high is still the one from 2021. You know, and it's very, very close to, you know, what will reach in April, and the high that eventually was reached in October, November 2021. But it is interesting to see that there is, you know, this is the, you can see the period where where Bitcoin appreciated strongly against gold. And as we, again, touched that level again, there was a strong demand on the way up. Could we get down and test it again? Yeah, sure. We could go even lower, probably. We could even, you know, go as low as 19. So it's nothing unusual. You know, nothing unusual. And there are periods that, so you can see between the high and the low, 15 to 2 again. So at the moment we're going 37 to 9. So it's nothing that is unusual in Bitcoin terms, and we haven't really seen the kind of a new high being established. Okay, so again, calculations 37. So let's say let's say without exaggerating too much, let's say if we establish a new high, I'm not saying going up, but if we get to 40 ounces of gold per Bitcoin, which wouldn't be a strong new high, just ticking higher from where we were before. Gold at the moment is at $2,500, so that would be $100,000. Okay, so the very minimum, if we are in effect going through a new bull cycle, that would be the very first target that I would expect to hit in terms of gold. If we were to look at what happened in the previous bull cycle, so the 16 to 37, so is more than doubled. Okay, so even and a little bit more. So we say they do a little bit less than that. We go from 37 to maybe 72 or 73. So 70 by 2,500. It's what the calculation. I can do it mentally too quickly. So we'd be around 175,000 to 200,000 if we had a slower increase from top to top. So you can see how these numbers are calculated when we're trying to estimate, what will Bitcoin do in this cycle. Assuming that there is kind of a slowing down of the peaks, as the market becomes more settled, more mature, we are everything is pointing at that well over the six figures, and probably at values they hover around the $200,000 mark. Okay, so obviously we are at 55 at the moment, so even in Bitcoin terms, we're talking about 3-4 times at least the values of today. What we will see in the future remains to be seen, but at the moment, let's have a look at what the future holds for us. Let me think. In terms of, I would say, job figures, going back to what we're starting to see in 2024, we're starting to see big layoffs in the technology sector. So we can see Dell laying off 20% of its workforce, Intel 15%, Tesla 10%, Cisco 12%. So these are kind of big numbers, and they should indicate, how, because these are obviously these people have got the trends well in line. They know what to expect, and they know what's coming around the corner. So so it's not surprising to see the stock market turning, and especially in if we go down here and we look at a couple of, so we can see the S&P 500, which is the general of making a top and now starting to make lower highs. But if we look on the Nasdaq, which is the technology index, we can see it's a little bit more pronounced now. So things are now starting already to hit about 10% drop from the high. It wasn't that, we're about 10.5% from the top. We're still technically in an uptrend. Okay, so we would have to break 17,000 level to start to stop this long-term uptrend, but the signs are starting to be seen, and the nerves are starting to hit the market. So not everybody's now expecting just like an easy ride and prices to go up forever. So on other, just a couple of things in crypto. Interesting to see now the big names, they're starting to have the to wet their feet in crypto as well. So Morgan Stanley, again, one of the the largest US financial institutions now, disclosed a 2.1% investment in the BlackRock Spot Bitcoin ETF. And on other news, the ex-chairman of Binance, Changpeng Zhao, which at the moment is in prison, is going to be released at the end of the month. At the moment, has been banned from holding any role in Binance. I mean, it's nothing to worry about. Obviously, he used to be the sole director of Binance. Now there is a board of 7 directors, but they want to distance themselves from him, so that because they are trying to become, you know, a more transparent force and be more appealing to you know, to regulators. And another thing, for example, from Binance is that they're going to re-enter India, for example. Both Binance and KuCoin, you know, they were banned from India, which again is a big market, for anything, but also for crypto. Will go back in India in 2025. So they want to distance as much as possible from rumors and bad news connected to his ex-chairman, and it should be seen as a positive news rather than negative. Okay, so we got a couple of minutes left. Let me stop my share and see if there are any questions, and then I will say goodbye for a couple of weeks. Okay, so any questions? Chad, go ahead.
Hello, Luca. Morning, everybody. And this couples into our long-term chat we had the other day around medical properties. Do you see the housing property a link to commercial? So in your graph, I thought it was fascinating, to gold. Do you think commercial property follows a similar trend, or is it its own challenges? Because I think what you were suggesting also in that medical REIT, it could be a good time to buy because there's a capital appreciation possibly too. So can you get your thought on both income and capital appreciation potentially?
Yeah, I mean, it's generally speaking, I would say what you should be worried about, commercial property is linked to how well the economy is doing. The economy is doing well, so there's more demand for commercial space. During a bad time, there's going to be pressure, both because of less demand on commercial space, and at the same time, at the moment, lots of pressure on funding rates for commercial property, because on one side, they got the revenues are coming down and the costs are going up. So there is pressure from that point of view for commercial, but then it depends as commercial and commercial. So we got an aging population in, you know, everywhere in the world, in particular in the States. So aging populations got more demand for, you know, health related supply. So I don't see that there is going to be so much of a there might be a downturn in the capital value of some of these assets, but in terms of demand for the services that, you know, the users of those assets are facing, you know, it's going to be, you know, continuous demand because people are real, you know, it doesn't matter if it's a recession or not. So I think from the point of view of the medical, you know, medical properties, there's still going to be I think personally, I think it's going to be a substantial demand. And even if you look at, you know, the ETFs the REIT that we're looking at, the UHT, the one that you're mentioning, you know, we can see, although there has been a downturn in the stock market, that REIT is actually keeps going up in value.
Yeah.
You know, so it's not going down. There isn't a strong correlation between the stock market prices and the price of that particular REIT. It means it's got its own demand, and it's obviously very attractive because of long-term management, the fact that they keep increasing the dividends every year and so on. So
yeah,
yeah, from that point of view, I'll be quite happy to, you know, park money there, especially during a downturn.
okay, thank you, appreciate it.
Okay, you're welcome. Last question, anybody?
Look, I've got a question about the keeping the cryptos. I've got a ledger, and you once mentioned there's another device better than the ledger, and I recently learned that they could get into the ledgers and read the ledger's seed phrases.
No, no, they couldn't. Sorry. It's only if you. So they've Ledger has started a service where they could help you if you want to park your seed phrases in 2 or 3 different places to help you recovery. Okay, but it's a service that they offer. And only if you want it. It's not they can't all of a sudden read your seed phrases and store them somewhere. It's only a service that you can use if you want to. And it's something that obviously worried the community. They are thinking, well, that's not self-custody anymore if you do that. But it's not something that it's pushed onto anybody. It's only if you want to use the service. So there's nothing changing on your ledger. So if you have a ledger, as long as you don't opt in to that, then nothing will happen to your seed phrase. The other one that we're talking about is the Trezor. Trezor is a community project as opposed to a company like Ledger. So that's why a lot of people are kind of like transitioning to that. But there is no worry about your seed phrase.
Okay.
Unless you want to share it with Ledger, and then there are some questions thinking, okay, how safe are they storing it? But even if you went with them, they don't store it all in one place. There are 3 different places where they store it. So it's very unlikely that all of 3 will be breached at the same time. But if you want to be maximum security for yourself, is to and self-custody is to store it yourself. So you don't.
Okay, you have to agree on those terms, and if not, then it's like it used to be.
Yeah. So it's a paid for service. So you would have to opt in and pay for that service.
Yeah.
It's not free. So it's don't worry about it.
Thanks very much.
Yeah, no worries. Okay, guys. So we'll close the call now, and in 10 minutes we start the AAW call. So go and refresh yourself, and I'll see you back in 10 minutes. And for those of you that are not part of AAW, then I will wish you a fantastic weekend and a good September. Remember that September normally is bad month for investment for both stock market and for crypto as well. So generally October is when we would expect for things to start turning around, but don't expect too much from September. Just enjoy the last little bit of summer that we have, and don't worry too much about your investment. But if you have lots of investment, big portfolio, then this may be the time to make some adjustments. Okay, so I will see you again on the 27th of September. Until then, goodbye and have a good time.
Thank you very much.